that's what time freedom's all about. The ability to do what you want, when you want, as much as you want with your time is kind of how I see time freedom. And it's mostly achievable, not solely, but mostly achievable when you become completely passive.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 238. Today's guest is going to talk about time freedom and how you can achieve it through real estate investing. He's also going to discuss how to transition from being an active investor to a 100% passive investor. Travis Watts is a full-time passive investor who has been investing in real estate since 2009. He's invested in multifamily, single-family, and vacation rentals. He's also the Director of Investor Relations at Ashcroft Capital, which was co-founded by Joe Fairless. Travis has invested in over 27 passive syndications and has made it his mission to share passive investment strategies in order to help others achieve and maintain wealth in real estate. Travis, welcome to the show.
Hey, Brian, thanks so much for having me, especially in these interesting times.
They are interesting times. We are recording this March 31st, 2020. So, I'm sure COVID-19 and the coronavirus will somehow work its way into our conversation. But why don't we just start with you and tell us a little bit about yourself and how you got started investing in real estate.
Yeah, so it's been a little over a decade. So I've taken it basically recession to recession. So I jumped in 2009. I got started with single family homes. So grew up in Fort Collins, Colorado. Had known I wanted to get into real estate at some point. I read early on a lot of the Robert Kiyosaki books and Rich Dad, Poor Dad, Cash Flow Quadrant, and realized the benefits of passive income and tax advantages that come from real estate. It was just kind of a weird timing situation. I was wrapping up college. I had to basically move out on my own, get my own place. It was just the right time to kind of get started in real estate, and bought a single family home. It's actually it was a condo. Ended up doing some house hacking in the beginning, so renting out some spare bedrooms as I was trying to kind of start my career off, and just started quickly realizing firsthand what passive income really was all about. I was, whatever it was at the time, $600 a month, I think I was renting a spare bedroom out for, and not having to do anything, as far as work. I was just, that money was coming in passively. So that kind of jump-started me into doing single family investing. I did some fix and flips. I had some buy and holds. I got into vacation rentals, and I was just buying my own homes every couple years, kind of somewhat distressed, and fixing those up and selling them a couple years later for some tax-free capital gains legally. And I was all about the single family stuff. I really didn't know what I didn't know. I wanted to be a passive investor. And what started happening, unfortunately, is I started becoming more and more of an active investor. And I was working an oil field job that took me away from home most of the time. It was 98-hour work weeks. It was just kind of the grind. I did it for basically just the income. It was a paycheck type of thing. And so, as I started stacking more and more single family homes into my portfolio, I just started realizing this isn't going to be a scalable model for me. I'm not going to get to 50 or 100 homes as I hope to one day have. And again, just to reiterate, this is what I was thinking at the time. This is just my story. It doesn't mean you can have 50 or 100 single family homes. I just didn't see that happening for me, even with property managers that I was putting in place. It was just too active. That was the bottom line. It was just way too active. And especially as I got into vacation rentals, that's more than active. That's literally a job.
You said you were working 90-hour work weeks at your W-2 job.
Right.
Plus, you're completely active in vacation rentals and all that.
Yeah.
How were you able to juggle all of that?
I wasn't able to do it effectively. Let's just put it that way. I was doing everything I could to field calls and to do the emails and the rent collection. But when things would pop up and I wasn't home, I was having to pull in friends, family, my girlfriend at the time, which is now my wife, just for these small things. Can you go adjust the sprinkler head over there? Can you go collect this rent check over here? And it was getting ridiculous. And I could just kind of see that closing in. That wasn't going to work. So I had to go back to the drawing board, figure out how are people actually passive in real estate? I mean, how can you actually have passive income, or is that whole thing just a myth? Is there no such thing as passive income? Is this what it is? Because it certainly isn't passive. And that's where I learned about apartment syndications, the ability to invest with other people in larger assets, like a 200 unit or a 300 unit apartment building, collectively. And then, so that's kind of broken down for those listening that may not be familiar. You have like a general partner or a sponsor. That's the person that is actually active. They're actually out there looking for deals and underwriting them and putting the legal docs together and creating teams and property managers. And then they're presenting that opportunity to the limited partners, which is what I am. I'm a limited partner. And as you mentioned earlier, over about 27 deals roughly. And so my job is to vet the operator and the deal and the market and to send in some money and say, I want to participate in that one. And then that's it. Then I sit back for anywhere from 3 to 7 years typically. It depends on the business plan. And then the cash flow and the rent collections happen, and I get sent what some people call mailbox money, ACH in most cases, every month. So that's a model that I found to be extremely helpful in my case. That's a model that allowed me to leave my W-2 job because it allowed for enough passive income coming in to replace my active income.
What does it really mean to be an active investor versus passive investor? Because you were kind of trying to wear both hats at the same time.
Yeah.
What to you is the distinction?
The distinction, it's vague. It's a gray area. It depends on, I guess, the receiver, right? The person. So to me, I would say nothing is 100% passive. In other words, as I just alluded to, even in the deals I participate in, I'm constantly having to vet out operators and syndicators and deals and markets, and things change and cap rates are up and down, and all this kind of stuff is evolving nonstop. So there is an active element to what I do. But once I make a decision and I say I'm investing in this particular deal and I send in the funds, it's now passive. It's completely passive. I'm not making any decisions. I'm not having to do any of the work or the renovations. I'm never getting a call from a tenant about a toilet or a leak or any kind of roof issue or whatever. That's all professionally managed and all out of my hands. So I consider being a limited partner passive. Some people would argue that if you have buy and hold rentals that are single family and you put a property manager over them to help with the day-to-day, they would consider that to be passive. Might be true. That's a model that, for example, my dad uses, and he's got whatever, like 8 single-family homes, but arguably, he's got a call every week he's trying to manage of something. It's always something that's popping up. So it may be 90% passive, but it's not 100% passive. So this approach I found is as close as I've been able to get to be completely passive in real estate.
Can anybody become a passive investor, or do you have to be accredited, sophisticated? Explain how that works.
Yeah. So accredited investor, for those that may not know, is a high net worth or high income individual. The definitions change over time, but it's typically basically a millionaire excluding your primary residence, or 200 to 300,000 a year in income, depending on married or single. Some, I don't know the exact percentage. Some syndications are for accredited investors only. So you must meet that criteria in order to participate. There are other types of syndications out there, like a 506B offering, for example, where you can have a pre-existing relationship with the operator or the sponsor, meaning they know you, your objectives, your goals, that you can understand the risks of the project and that you fully know what's going on, have the ability between either yourself or you and your advisors to make a decision on whether or not this investment makes sense to you. You can then take part in those projects. Usually, I think it's 35. What they call sophisticated investors can take part in each of those deals. Aside from that, there's now Regulation A offerings out there. A lot of those are offered through like crowdfunding platforms and things like that, where you can take on unlimited amounts of non-accredited. And then if you want to take it as far as to say like REITs, real estate investment trusts that are publicly traded, you could also buy those too, just in the stock market for, as little as whatever, $50, whatever the share price is, $10. And a lot of times those will give distributions also. I don't take part in a lot of those simply because the volatility of the stock market, as we all know, just look at the last couple of weeks. It's a whipsaw. You're up and you're down, and I can't stomach it. I can't look at my portfolio and tomorrow I've lost $100,000, and then the next day I'm up $100,000. I just can't deal with it. So everybody's different, but that doesn't fit my risk tolerance, if you will. But there's many ways to get involved, and all of those would be passive opportunities, in my opinion.
I'm wondering what the difference is in income between active income and passive income, because you were very active and I'm sure you were probably making good money on top of your W-2 income. Now, as a passive investor, are you doing as well, or do you have to accept maybe a little lower returns, but you have a lot less work that goes into them?
Yeah, it depends on the deal, and it depends on the type of syndication you're in. There's a syndication just basically means a group of people pooling money together to go do a project. That could be a new development project. That could be a value add pre-existing, project. That could be any sector. That could be retail and office and storage and mobile home parks and multifamily. There's so many things. So syndication's kind of vague, kind of broad. What I focus in is the pre-existing product out there in the multifamily sector. So these are properties built in the 1970s, 1980s, 1990s, early 2000s that have a value add component, meaning it needs some help, it needs some work. Maybe it needs new landscaping, new roofs, new HVACs. The units are outdated, the appliances are old. And so we're going in, when I say we're, the sponsor team is going in as their business plan to renovate all of this stuff to make a better, safer community to where market rents can come up to, just market level, basically. And then we can sell that deal in 3 to 7 years typically. So leading up to today in this crazy chaos that we're in, it's worked exceptionally well for me. In most cases, not all, but in most cases, I was actually making more being passive than I was being active, which is kind of hard for a lot of folks to understand. And that's very specific to my story and the markets that I was in and the timing that I was doing all this in.
Well, explain it a little bit. I'd like to know, get into some numbers here, some examples of active investments and the returns you made versus the passive investment returns that you're making.
Right. So when I was doing single family, as I said, I got started in 2009, which, by the way, a lot of people think that was a great time. Really wasn't a great time. A lot of markets were still on a decline. If nothing else, we were just flat. So, you weren't seeing big rent growths and appreciation, anything like that. So the first few deals I did were just meh for, 3-4 years, nothing really happened. And then as we get into 2011, 12, 13, 14, 15, the market, specifically the Front Range of Colorado, where I was investing between Fort Collins and Greeley, Windsor, Loveland, Commerce City, Henderson, all these a lot to do with oil, by the way. They were appreciating like crazy. Like 10% a year in a lot of areas, just year after year. So it wasn't that hard to make money in that time period. I would argue that would be extremely hard to do in today's environment in the Denver and the Denver metro area. So it was market timing. That was a lot of my success. Now, the other half was obviously that I was buying something distressed that needed help, and I was painting it and renovating it and making it better and then selling it. That's the classic fix and flip. And a lot of times what I'd do is fix it up, rent it out for maybe a year, and then sell it. And I would do that for tax reasons. That's kind of a side strategy. But anyway, so let's dig into numbers. I got to be honest with you. I wasn't that good at what I was doing. And that was a self-realization that came later is, I'm maybe doing a flip and then making, $30,000 a year later, but then understanding the more I network that there's people doing the same thing I'm doing that are making 150,000, 200,000 in the same time frame, doing it way more efficient and way better. I'm not a handyman. I had to contract everything out. I was not able to find the best deals, just okay deals, and things like that. So leading up to 2015-16, that's where I made the big shift to syndications because I started seeing my margins going down, my yields going down. It was becoming way too active, and it felt like everything was closing in. So that's where I found syndications in other markets. So there were still markets in 2015, 16, 17, 18 that were booming, and it was not the Front Range of Colorado. So I started partnering with people in Dallas, Fort Worth, Tampa, Florida, Jacksonville, Orlando, Atlanta. I did deals in all kinds of states, but it didn't matter that where I lived because their expertise was in that local market and I was completely hands off. And that's kind of the beauty of it. I think is a real estate guy's quote that live where you want to live, but invest where the numbers make sense. And, that simultaneously, that quote hit me around that time. And it just made so much sense. And so that's the philosophy that I adopted was people are doing this a lot better than me. They have way more connections. They're in markets that make more sense. So why don't I just piggyback off their success instead of trying to do it all myself and thinking that I'm some guru or expert? Because clearly I'm not.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Or what kind of returns were you getting then from your passive investments with other syndicators?
From single family, from a cash flow standpoint, because that was my main focus, actually, believe it or not, was cash flow. I was getting anywhere from 10, 11, 12% annualized returns in the single family space. But I was having to be active and manage that whole process or pay a property manager where my yields went way down. So when I went to being a limited partner at the time, the first deals I was doing, it was still somewhat in that range. A few deals were at 9%, and then 10, and then 11. They would incrementally work up, and then there would be the sale on the back end. So then you got to factor that in. So overall, it was pretty solid returns. Now, as we've moved forward to 2020, yields and cap rates have compressed a bit, right? So what used to be a 10% a year project is now maybe a 7 or an 8 or something like that. And now we'll see in the next 6 months or so kind of what happens, right, with coronavirus and the whole economy that we're kind of moving into now. So yes, but the way I look at it is this. Let's say I have a single family home today and I'm debating, do I do a syndication or do I do a single family home? Well, a single family home gives me, let's say, 15% annualized return, just to use a flat, simple number. And the syndication gives me 10. Well, then you would assume single family is a better way to go. But the way I see that is you're paying yourself a 5% margin for the work that it's going to take, the work to get this under contract and the closing and the management and putting the team together and all this kind of stuff. So you really got to think, is that worth my time? That 5% margin, whatever that equates to annually, if it's $3,000, is $3,000 worth my time throughout the year having to manage that project? And that's how I see it. So at the end of the day, I see it as both of those deals are going to give you a 10% return. One's going to require your time, and you're going to give yourself a little premium to compensate for your time. So everybody's different, but that's how I kind of look at that.
Well, that brings us up to the concept of time freedom, which is something I know is important to you. Can you kind of discuss that, like what time freedom actually means to you?
I don't know who coined this term. I like to think I did because I started saying it, but I'm sure I didn't. But time freedom is basically the ability to choose having the freedom to choose what to do with your time. And if you really let that sink in, that's a huge concept. For everybody, this is different, by the way. Some people just want to leave their job like I did. I hated the work that I did and I wanted to be done with it. For other people, they love their career, but their career takes 100 hours a week of their time, so they would rather work 40 hours per week, or they'd rather go part-time. And for some people, they want to be home with family more. For some people, they want to travel more. For others, they want to do charity and church events and all this kind of stuff. So everybody's kind of got a different why and a different reason or thing that they would do with their time. And so the way I like to think of it is, so if you had infinite wealth, don't worry about the numbers. If it was just infinite, you don't have to work anymore. What would you do with your time? For some people, that's a quick answer. And for others, that could take months to figure out or years to figure out. But that's what time freedom's all about. So how does that relate? When you're completely a passive investor and you have nothing but passive income rolling in that not only covers your lifestyle expenses, but there's an excess margin in there for safety, you then have that ability. I had the ability to step away from 100-hour work week job I didn't like and then start pursuing work that I thoroughly enjoyed, that I thrived from. And to me, that meant so much. I mean, that was so powerful to realize that was real and that can happen. And my wife and I, by the way, I mean, we travel the world. Travel is a huge thing of ours. Obviously, we're not traveling right now, which is a bummer. But yeah, so that allowed us to take off and to do trips like that. So that's what time freedom's all about. The ability to do what you want, when you want, as much as you want with your time is kind of how I see time freedom. And it's mostly achievable, not solely, but mostly achievable when you become completely passive. Because if you're going to be a sponsor, general partner, self-manage all this stuff, a lot of times you're not going to have the ability to step away for 3 months and go take a trip somewhere across the world, right? Because you have obligations. You got to be there locally.
So Travis, what would you say to our listeners who don't have a high-paying W-2 job, maybe don't have the money to meet a $50,000 minimum to invest in someone else's syndication? How can they get to where you're talking about with the time freedom and the ability to become a passive investor?
Yeah, that's a great question. So some listeners may be familiar with the FIRE movement. It's something I actually just learned about a couple of years ago, but I've always followed the process of what the FIRE community really does, which is no matter what you make, you can make $30,000 a year, you can make $1 million a year, doesn't matter. You make some money, you live below your means as much as you possibly can, and then you're putting all that excess savings, where you're living compared to what your income is, into investments. In my opinion, investments that produce passive income. And then it's just, it doesn't happen overnight. For some people, it takes 5 years. For some people, 10. For some people, 15, 20 years. But the idea is that you get to this point of time freedom. You get to this financial independence. That would be the more broad term that's used in the industry, is financial independence. So regardless of income, if you don't work in the oil field and you're not a doctor and you whatever other high income sources there are, I still think you could start assuming, hey, I've made 20,000 before, in annualized income. So, and I still had a margin in there. I still was funding a Roth IRA back then, which is crazy to think about, but I did. That was just after college. But so that's the point, is having enough self-discipline to say, yeah, I don't make a lot and it is tough, but I maybe could save 10%. I maybe could save 15, 20% of my income, depending on your level, and then dedicating to that and making that a repeatable process. And then I think where a lot of people kind of miss the boat, so to speak, on this movement is they invest solely for equity, right? They go into to index funds or to their 401k and they say, I'm just going to throw it over there. And when I'm in my 60s, we'll check it out and we'll see what's going on. Hopefully that's enough to retire on. But there's never been the ability to produce passive income because all of their savings are going into something they can't touch anyway and is mostly invested in just equity. We hope that the markets just always go up forever. And that's the strategy that most people will use. So I would just say, if you do want to potentially have time freedom or go the passive route. It's certainly not for everybody. It certainly doesn't mean you should start there. But, like I did a lot of fix and flips and active stuff for equity as well in the beginning. So I wouldn't have started with a syndication day one. I don't think that would have been the right move for me. But yeah, I think that's a way to look at it, is just do what you can, do small amounts, and maybe start in the liquid sector like we talked about with REITs and stuff like that. You could start with $10. If you don't have $10, then it's going to be a rough journey to get to be a full-time passive, I think.
Let's go there. If you don't have $10 and you're listening to this, and now is a great time to start thinking, okay, because there are people, you could probably say 30% of our audience is now out of a job because of this coronavirus. They're sitting at home out of a job wondering, okay, how do I dig myself out of this hole?
Yep.
This is a great place to start right here and now.
Yep.
Start figuring out, how do you cut your expenses? How do you save that money? How do you start following Travis's advice to invest in a REIT or some sort of profit type instrument, whether it be stock market, mutual fund, REIT, real estate investment of some sort? How do you get there? And you're right, it's not an overnight type process. It could take 10, 15 years, but this is a good time to start.
It is. It's that famous saying, history doesn't repeat itself, but it rhymes. Here we are again, right? 2008, 2009. It's not the same. We didn't have coronavirus then. And that was more of a real estate crisis, so to speak, from a high level. But, markets are down. REITs are down. REITs are down way below, in a lot of cases, their actual net asset values. So it's kind of betting that those are going to come back or not, But yeah, this is a great time to self-educate. So let's say you're in that unemployed bucket right now. I'd say your first thing to be doing right now is find a job, right? I mean, find whoever is hiring. Is it, can you go work at Amazon, or can you, what are these employment centers? Maybe start an e-commerce business or something online. Just do whatever you can do to get your income rolling again. That's number one. Number two is a great time to self-educate. If you don't have the $10, go to the library and pick up a few books. It's a great time to start that self-education journey, because more importantly than just jumping in and investing is knowing yourself, knowing why you're investing, and knowing, quite frankly, what to invest in. And so that's going to come out of education. Listen to free podcasts. There's a world of information out there, but it shouldn't be first. If you're unemployed, you need to be looking for getting your income back. But then second would be self-education to me.
I want to get back to passive investing. And as an investor, I think you said 27 passive investments of
right.
that other people have put out that you're invested in.
Right.
How do you go about vetting those sponsors and those deals?
Yeah, well, I didn't know what I didn't know when I got started. So the first couple deals I did were just with a local sponsor. For some reason, I thought that would be important to partner up with someone that was 3 blocks away from me. It ended up being not important at all. And in fact, it was a mistake, in my opinion, because they didn't have an adequate track record. They didn't really have past results to show for. It was just more of the optimism and confidence and excitement to get started in this world. They just wanted to do a deal, and they saw the money making potential in it. And I, quite frankly, I liked the sponsor a lot, as an individual. But as far as a business person, I never should have invested with them, And so they the first couple of deals, they kind of butchered up the business plan quite a bit. They couldn't do what they said they were going to do. It was supposed to be like a 5-year hold, and they ended up selling about 1.5 years in to the project because they didn't know what they were doing. So that really taught me that you can't just look at a pro forma or an overview to a project, right? These are projections. Everybody listening that doesn't know, these are just anticipated returns because nobody knows the future. You can't just take that for face value and say, wow, it's going to produce 10% over the next 5 years. I'm in, because it may not. There's a lot of risk involved. And so what I've come to find, what I used to do is vet the deal first, and then the market, and then the team. And I've completely flipped that. So I spend all my time now vetting teams and their track record, and have they done it before, and are they consistent with their business model, and all those kinds of things. Number 2 is the market. I'll explain a quick story on that. With one of those first groups, even though the group couldn't execute the business plan and they didn't have enough experience, quite frankly, they did do something great, which was they bought a great product at a great price in a great market. And so the market saved us. The market went up. There was a lot of demand. People were moving there. Occupancy was super high. And even though they couldn't renovate and they couldn't actually manage this thing, we ended up profitable. They completely screwed up the business plan and we still ended up profitable. So I like being in the value add space. You usually have a margin of error built in where you're buying a little below the market value, plus you have room to grow it as you renovate. So operator first, market second, deal third. If the first two are in place, you eliminate a lot of your risk. Not all of your risk, but a lot of your risk right there up front. And so then you just kind of know more or less you're going into a pretty decent deal. That would be the odds, right? I still vet the deals, of course, and I go visit them in person, all that kind of stuff. But that's my approach now. That's how I do it.
So with 27 different deals that you've invested in, there must be some that are doing better, some that maybe aren't doing well at all. What's been your experience with these different investments?
I've got about 80% of my portfolio, my investable portfolio, in value add B and C class apartment communities. That's basically affordable housing. Done a lot of back testing, a lot of research, talked to a lot of people that have been doing this way longer than I have. And I just decided that was going to be my focus. I wasn't going to do new development. I wasn't going to buy D properties in the ghettos and try to turn them around. And I wasn't going to do these 20% occupied projects that have catastrophic failures built in and then try to fix them. I was just going to go with something stabilized, already cash flowing with a long-term track record of being able to show those rents and collections. And I was going to focus on cash flow. So most of what I invest in has monthly distributions, monthly cash flow. So to your question, all the deals that I'm in are performing or overperforming with the exception of, I think 2 of them are slightly underperforming. In the real estate space, again, knock on wood, here we are in coronavirus land, but I haven't lost money yet in a syndication, but, I fully expect to do so as time goes on. I don't know how that's going to unfold, but you gotta adjust for risk, when you're investing in anything, just like the market crashed 30% recently. You just have to know that's going to happen at some point and just be okay with that. So I kind of have that allocated. And one of the groups, my wife and I, here's a quick story. My wife and I sat down years ago, about 2015, 16, and I told her, we weren't married at the time, as my girlfriend. And I told her I wanted to be completely passive. I wanted to do these syndications, and she understood just through me blabbling every day what that meant. And I sat down, I did my criteria. I want to be in these states. I want to do value add. I want to do apartments. I want to do this, track record, all that. And so we came across Ashcroft Capital, Joe Fairless's firm, and I got to talking with Joe, and coincidentally, they checked all the boxes that I had set out to check. I didn't even know who Ashcroft was at the time. So we did 1 deal with them, and then 2, and then 3, and then 4. I think I'm in 9 deals with them currently. And that kind of led to that relationship where I became part of their investor relations team to just speak to other folks out there in the industry about who they are, what they do, and why I continue investing with them personally. And so again, this all gets back to time freedom. What do you want to do with your time? Well, I found something that has hugely benefited my life, my wife's life, my dad's life, family members of mine. I want to share that with people. It doesn't mean it's appropriate for everyone. Certainly not. It doesn't mean they're the only player in the game. Certainly not. But it's been a great experience. And so that's what I choose to spend my time with, is just talking to folks, a lot of which are accredited and that want to get into multifamily, and they're looking for cash flow and monthly distributions and things like that. So they've done a great job for us. Other groups that were newer, not so much. And a lot of in the middle, right, to be determined. We'll see. A lot of the deals we've done have been in the last couple of years. So it's too soon to tell.
What have you noticed that separates the top operators from the kind of substandard operators?
I think having an adequate sized team is hugely helpful. There's been some groups we invested with where really it's just a couple people running the show. Well, what happens is they get very busy. They're trying to do new deals. They're trying to manage their old deals. They're trying to be investor relations. They're trying to raise capital. And so when you have issues or questions, it's hard to get a hold of them. You're sending emails, you're not getting responses, you're leaving voicemails, you're getting a call back 4 days later. I look for solid communication, enough people to handle the workload. And track record is probably the most important. I would say for anyone looking to do your own deal and you don't have a track record, try to get somebody on your team that does. Maybe they're just like a mentor or a partner, like a co-GP or something, just somebody that can bring some credibility to the stage that has done this before multiple times to help you out. Because anymore, man, I got a little burned out with, those investments I made where folks didn't have a track record, and it turns out they couldn't actually do what they thought they could do. So, by the way, I have a free passive investor resource guide for any of your listeners that goes into I'm talking high level right now. This goes into all the details about how to vet an operator, a market, a deal, internal questions to be asking yourself, questions to be asking a sponsor, way more depth than we can go into here on the podcast. Your listeners can get that at, ashcroftcapital.com/passive investor. It's just a PDF free download. So feel free to use that.
Let's talk a little bit about just investor communications, since you're Director of Investor Relations with Ashcroft, and you certainly are on the receiving end of communications with your sponsors. What are some of the best practices?
One reason I look for monthly distributions isn't just to get paid monthly. Obviously, that's nice, but it also goes hand in hand with monthly reporting. So I like to know proactively, or at least as current as reasonably possible, what's going on with the project. What's the occupancy? How many units have been renovated in the last 30 days? What are the resident events that we're doing? What's the local economy look like? What kind of employment is coming to that area? All those kinds of things. I just like to keep up with it, not once a quarter, not once a year. I like monthly. So Ashcroft does a great job at that. They're very proactive. So, a tornado comes through, the area where they have some properties. So they're communicating with investors in a proactive manner. Hey, this happened. I'm sure you saw that in the news. Our properties are safe. We got it taken care of. We got boots on the ground. Nobody was affected. Everybody's safe. That's great to know. Don't make me wonder. Don't make me wait 4 months to find that out. Don't make me call, And so I think proactive can go a very long way with investors, showing them the actual financials so that you're not wondering, wonder if they're trying to hide something or if there's really a problem they're not addressing. Just be transparent. That's the other thing. Be transparent, be proactive. And when somebody calls you, get someone to call them back. If you're busy, if it's a Saturday night, field the call to somebody who can return the call, So I pride myself on doing that. I'll answer a call on a Sunday. Joe Fairless will answer a call directly on a Sunday. Anytime, we'll get back with you as soon as we can. And I think that goes a long way, especially with folks like myself being a limited partner. I look for that.
Along those lines of investor relations, what are you noticing is being communicated right now? Tomorrow is April 1st. Yeah. We're all wondering if rents are going to be paid. By the time this comes out, we'll know. What kind of communications are you seeing from your sponsors?
Yeah, so that's kind of the cool perspective, I guess, that I have is working with, it's actually 14 different groups, 27 deals, 9 with Ashcroft. So I've been on a lot of conference calls. I've read a ton of emails. Everyone seems to be sending you an email about what they're doing in relation to this COVID-19. And so I've got an opportunity now to kind of feel out the industry, at least from my point of view, what people are doing. Sponsors and syndicators typically are kind of on pause right now. In some cases, they can't be renovating. They can't have people in other people's units, right? And so everyone's pumped the brakes, right? It's hard to underwrite a deal right now because we don't know what rent collections are going to be in April. We don't know what they're going to be in May. We don't know if this whole thing's going to last through July? Nobody knows. And so it's too hard to predict. This is a solid deal today. I'm going to do it. And then next month, you've got 50% occupancy. That could be a disaster. So I've seen a lot of deals cancel out, backed out of contract. They're not moving forward with them. And a lot of these groups are generally saying, we're going to wait it out a couple months. We're going to see what the actual impacts are. And then we suspect we're going to have an influx of deal flow coming our way in which we are prepared to take advantage of when they do come our way. So maybe we'll see, cap rates raising a little bit, maybe some price compression, but nobody has the true answer to that right now. So I think it's a waiting game. As you said, tomorrow, it's a true sign. Really, over the next week, we'll say through the 7th, we'll really have a good idea on our properties as to what this impact is and how many people are affected. Is it really 30% or, in the stimulus check coming out to people, how is that going to play in? Is that going to allow them to pay rent? Anybody's guess right now. So it's a waiting game. We'll wait and see. I don't know.
So are you doing anything in particular right now, Travis, to kind of prepare yourself for whatever may happen?
I am. So something to point out about syndications, not a lot of people talk about this, but there is a possibility in a lot of syndications for what's called a capital call. So a syndicator, a responsible syndicator, is when they underwrite up front and they make a CapEx budget, capital expenditures, they're trying to collect enough money to do the entire business plan. So raise enough money to go 5 years out to renovate all the units, to have reserves in case of tornado and flood and fire and all that kind of stuff. So a good syndicator is going to have that already allocated. But right now we're in a complete unknown. And if we start seeing occupancy dip way down, there could be a capital call. And what that means is that the general partnership can call upon the limited partners and say, look, we don't have enough cash right now to cover our expenses. We anticipate this being a couple month issue. We need this much per investor. We need you to send that money in to keep this project rolling. And that could be, it depends, $5,000, $10,000. So what am I doing right now? I'm preparing for all the what ifs. I am stockpiling cash right now. I'm not investing personally right now, probably at least for 2 months. And I'm just taking all my cash and saving it up. You never know what's going to happen. And I just want to be prepared for that. And it never hurts just to have a little excess reserve, right? I mean, if it all blows over in a couple months, I can go right back into investing. So that's how I'm preparing.
Any parting thoughts for our listeners? Any observations or advice that you want to leave our listeners with?
I just think, given the current circumstances, take care of yourself, take care of your families, take care of yourself financially, right? I mean, if you don't already have a reserve fund built in, that should be your focus right now, just on a personal note, right? You need to have X amount of months living expenses to cover you if you do lose your job, or if you have to change careers, or you take a pay cut, or you're furloughed, whatever. There's all kinds of tragedy stuff going on right now. And that would be one of the first things. If, as we mentioned earlier, if you have been laid off, your job is to get a job, and then self-educate if you can during this process. It's probably not healthy to be watching the news 24/7 and getting all the negativity in your brain and getting fearful and scared, because that's kind of what caused the market reaction in the first place. So, stay strong mentally, physically, and just take advantage as best you can as being home, whether that's with family or you got time to read now, or whatever that means for you.
And Travis, if someone wanted to get a hold of you or find out more about you, how would they do so?
Email is usually the best. You can reach me at travis@ashcroftcapital.com. And again, that free passive investor guide is ashcroftcapital.com/passive investor. You can reach me there. I'm on Facebook. I'm on LinkedIn. I'm on, Bigger Pockets, all the social media stuff. So you can reach out there too, and happy to connect, whether you're, doing single family stuff or fix and flips, multifamily, you want to get more passive, all that kind of stuff. Just happy to share experience. And now's a great time. And I got all the time in the world now. So give me a call.
Well, thanks so much for taking the time to just talk to us about time freedom, best practices as a sponsor, communicating with your investors, what it means to be a passive investor versus an active investor. It's been a great conversation. Thank you so much.
You bet, Brian. Thank you. Really appreciate it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.